You worked your whole life to get to retirement, so why does the IRS still want a piece of it? Retirement may mean you're no longer earning a paycheck, but it doesn't mean you're done paying taxes. In fact, your tax situation can get more complicated once you retire, not less. Social Security, pensions, investment income, traditional retirement accounts, Roth accounts, taxable accounts, they're all working together behind the scenes. And how you take money from those accounts can affect your income taxes and even your Medicare premiums. So let's break down the tax issues every retiree should have on their radar. The tax code is complicated, and retirement planning is about a lot more than just knowing your federal tax bracket. Several different tax rules interact with each other, sometimes in ways you won't see coming. Here are 5 areas every retiree needs to understand. Let's start with required minimum distributions, or RMDs. If you have money in traditional IRAs, 401ks, 403bs, or certain other tax-deferred accounts, the IRS eventually forces your hand. Once you hit your applicable RMD age, you have to start taking withdrawals whether you need the money or not. For many retirees today, that age is 73. Some younger retirees won't face it until 75, depending on their year of birth. An RMD isn't just a withdrawal. It's generally taxable income when it comes from a traditional tax-deferred account. That means you could land in a higher tax bracket than you expected, especially if you've been a diligent saver. Waiting until the IRS forces you to take large distributions isn't always the smartest move. That's why the years before RMDs begin can matter just as much as the years after. Here's another one that surprises a lot of retirees. Your Social Security benefits can be taxed by the federal government. Depending on your combined income, up to 85% of your Social Security benefits can be included in your taxable income. Notice I said up to 85% included, not taxed away. The government isn't taking 85% of your check. It means up to 85% of your benefit could count towards your taxable income when your return is calculated. This is exactly why retirement income planning matters so much. Your IRA withdrawals, pensions, investment income, and other sources all influence how much of your Social Security ends up taxable. So don't look at Social Security in a vacuum. Look at your entire income picture together. Now here's one that can really blindside you. It's called IRMAA, the Income-Related Monthly Adjustment Amounts. If your income crosses certain thresholds, your Medicare Part B and Part D premiums can jump, sometimes significantly. Medicare typically looks at your income from 2 years earlier to decide whether you owe the surcharge. So that large IRA withdrawal, Roth conversion, or capital gain you take this year could quietly raise your Medicare premiums 2 years from now, long after you've forgotten about the decision that caused it. This is exactly why tax planning can't just be about minimizing this year's bill. Sometimes paying a little more in taxes today protects you from a much bigger cost down the road. Where you withdraw your money matters. Not every dollar in your retirement account is taxed the same way. Withdrawals from a traditional IRA are generally taxed as ordinary income. Qualified withdrawals from a Roth IRA can potentially come out completely tax-free. Withdrawals from a taxable brokerage account might involve some mix of capital gains, dividends, and other taxable income. In other words, stop thinking of your retirement savings as one giant pile of money. You actually have different tax buckets: taxable, tax-deferred, and tax-free. The order you draw from those buckets and how much you pull from each can make a real difference in your overall tax bill. For many retirees, a coordinated withdrawal strategy across account types leads to a far more efficient retirement. Which brings us to Roth conversions. A Roth conversion lets you move money from a traditional retirement account into a Roth account. The amount you convert generally counts as taxable income that year. So why would anyone volunteer for a bigger tax bill? Because you're trading a known tax cost now for potentially tax-free qualified withdrawals later. Done well, a Roth conversion can also shrink the balance that will eventually be subject to RMDs. But be careful. A conversion raises your taxable income for the year, which can ripple into how much of your Social Security is taxed and whether you trigger those Medicare IRMAA surcharges we just talked about. Roth conversions aren't a simple "I'm in a low bracket, so convert everything" decision. Careful consideration must be put into how much you should convert and when. Here's the bigger lesson. Retirement tax planning isn't just what bracket am I in. You also need to think about when your RMDs kick in, how much of your Social Security could be taxed, how your IRA withdrawals affect your total income, whether Medicare IRMAA surcharges are lurking, which accounts you pull from, and in what order, whether a Roth conversion makes sense for you, and how today's decision might show up on a tax bill years from now. None of these decisions happen in isolation. A withdrawal that looks perfectly reasonable on paper can quietly trigger a tax consequence you never saw coming. And the strategy that saves you the most this year isn't always the one that saves you the most over your lifetime. If you're approaching retirement or you're already there, don't wait until tax season to find out what your income strategy actually costs you. Tax planning shouldn't be an afterthought bolted onto your retirement plan. It should be part of the plan from day one. And remember, don't strive to just pay the absolute lowest tax bill every single year. Make intentional decisions that let you keep more of your money, protect your quality of life, and make your retirement income last as long as you do. If this was helpful, subscribe for more retirement planning strategies that can help you make smarter decisions about your money.